Let's start with the top line, which is we broke 145 on dollar yen. 20 billion bucks in unilateral intervention so far. It's going to take a lot more than that to stop the yen. Do you reckon?
Yeah, it's going to take the Bank of Japan to move its policy stance. We've called it fundamentally when we're at 135, 140, 145 on dollar yen. Until you address the root cause of the problem, there's no point trying to just patch this over with cosmetic intervention. Now, the Bank of Japan is very clever in the sense that how it executed this 20 billion kind of buy order, it did it in a stealthy way to add that kind of risk into markets and to remove the possible speculation side of it, because all of a sudden you do have that kickback. But the problem is, as soon as the fundamentals come back into play, it's just going to drain the Bank of Japan's reserves.
The problem is the strong dollar. You need to fix the root, as you say, of the issue. So until that happens, what will be the effect of Japan, potentially other central banks, continuing to intervene to no permanent effect?
I think they're just laying out speed bumps. I don't think they necessarily have the intention here of completely reversing the course and strengthening their own domestic currencies. It's just to stop something that is a bit more synonymous with a crisis, and to just really kind of slow markets down from getting that free money on what is quite an easy, short-sighted option.
It's about reintroducing two-way risk. That's all it is. It doesn't stop the truck. It just slows it down. OK, so we may get sizable concerted intervention. That's a new and live risk. The one thing we looked at this morning was the cost of dollar funding, the constriction in dollar funding, which is nowhere near 2007. So just let's everybody be very clear. We're not making some kind of radical call. But what we are flagging up is the risk. And this is the FRA OAS spread. It's back at pandemic highs. It's nowhere near 2007. When does that liquidity jolt turn into something much more manifest that you worry about from an FX perspective?
I think it's when we start to see central banks discussing it quite aggressively, and then start to see some
liquidity?
Multilateral, yeah, exactly. We start to see some kind of multilateral communications on this before them swap lines are open.
To be fair, Brainard has mentioned it. She said in a speech Friday, cross-border spillovers and financial vulnerabilities are a consideration for the Fed.
They are a consideration. I think that's also looking at what happened on the gilt market last week and then the impact that had throughout fixed income markets. I don't think we're necessarily looking at it from an FX standpoint as something that's highly concerning, especially not at these levels. Now, if volatility stays higher and then all of a sudden we see another 3-4% jump in the dollar, I think that's when people are starting to get a bit kind of twitchy.
Twitchy. Twitchy.
I'm a bit twitchy.
I tell you what, I want to see the Amex bill when it comes in. I don't necessarily know. It's got a lot better for me. I'm paid in dollars, I'm paid in dirhams, so, you know, London was a breeze for me. But if I look at sterling, let's dig into this a little bit. We're 8% off the lows last Monday, so we're back at levels that we were before the catastrophic budget communication, mini-budget communication. We've got a confidence deficit, a clarity deficit, and a credibility deficit. Do you think they attack the pound again, even though it's up 8% from the lows last week?
I think so. I think this is very shaky ground, what we're seeing. And I looked at last week's price action and thought this is more of a technical reason for a rebound here. Month-end flows, some kind of adjustments in portfolios. I don't necessarily think it's all of a sudden that the storm's passed and all of a sudden we're in clear water. By no means. Once that current account deficit data starts coming through in Q4, more political noise in the background, and then all of a sudden potentially another ramp up in European gas prices, which only just extends the government's liabilities.
So then what's fair value? What's fair value in the pound right now?
At the moment, bearing in mind the government's balance sheet could just completely stretch out even further over the winter. I mean, it's how long is a piece of string? It's just the easiest option.
Come on. You can't come on to Daybreak Europe and say sterling's as low as a piece of string. Come on. Is it going to break parity? Where's it going to go? What does a re-attack on sterling look like? What does a credible attack on sterling look like? Take us through it.
I think in the short term, 105 is kind of the big level. I mean, we're talking all-time lows at 103.40 in very illiquid markets. For a lot of people, they would look at that and say that's just a synthetic price. Once you can start putting some serious volume through at those prices, then we'll actually start calling that a low. So 105 is really kind of the level that markets are looking at, thinking this is the next psychological barrier.
What is the risk of a BOE that disappoints in terms of a market that at the moment is pricing in over 100 basis points worth of hikes from a BOE? How realistic is that, and what happens to this market if they don't go through with it?
For what it's worth, I think 100 basis points is on the light side of things. I think the Bank of England really needs to come in and backstop this, especially if there isn't a U-turn from the government, either because of their own admission or...
The Bank of England have already told us that they've put a stick in plaster. It's a temporary reprieve in terms of the intervention in the gilt market, which broke, by the way. You wouldn't think that from walking around London at the weekend. They've told us it's temporary. This is monetary policy must lead for a credibility void to be filled.
It has to, because one of the kind of main pillars of UK investment is the fact that there's institutional credibility. So if that's then lost, then all of a sudden it becomes a very tricky climate for foreign investors coming into the UK if all of a sudden everything's kind of being moved by the same lever, which is the government policy. So I think they do need to have a credible stance, but at the same time they can have a credible stance by ramping up interest rates, because you look at what the government policies are, they're inflationary. So the Bank of England will have to come out. If we roll back 2 meetings, Governor Bailey explicitly said the reason why they went up to 50 basis points is because they don't like the fact that businesses can pass through these costs to the consumer. Now the consumer's got a better balance sheet, then all of a sudden they are able to do this. So the bank has the kind of economic rationale.
But are they able to do it because of all of the floating mortgages in the UK? I mean, hiking by 100 basis points, that would be some pretty extreme pain for folks out there in their mortgage payments.
Yes, but, you know, it's the lesser of two evils at this point. Do you do that, or do you then have kind of a perpetual inflation problem that you have to catch up on over the next 5 years? So we actually think the bank's going to go big, but it won't be for long. We're not talking the Federal Reserve that wants to keep these interest rates restrictive for the next 12 months. We think it's going to be do it quickly, take the short-term pain, then start to ease as we come into the kind of more stable part of the cycle.
How does the dollar translate that hike, temporary hold? It's a very different context that you're putting forward. Other people are talking about a much longer and enduring holding pattern from the Fed. If you're looking for a rollover, when does the rollover in the top of the Fed come? And does the dollar begin to price that in? Are we near? I know we ask it every time you appear, but should I prepare for an exhaustion in dollar quickly?
Every time you ask me, I say it's not quite ready yet. I think we're looking at least Q2 next year, if you need a quick answer on that.